Hello and welcome. My name is Jared Goodwin and I'm an algorithmic trader, and today we're going to talk about making money trading the FTSE 100. I'm going to call it the FTSE first hour breakout. It's not my strategy. Actually, a subscriber of mine reached out to me and emailed me with the rules for this strategy, and he said, I think you might like this because I've been doing quite a lot of work on the FTSE looking at strategies lately, and he said that he'd been using this one with quite a bit of success. So he said, why don't you have a look at it and test it out? Luckily, I use Multicharts, which is a trading and backtesting platform. So all it is a case of me programming the rules, and then I can backtest it and see how it performed in the past. I can look at making adjustments and optimizing different inputs. It's very fast when you're using decent software like that. So it's using the FTSE 100 index. I'm actually using data for the CFD, and I'm using data from 2008 through to the end of 2018. So we're looking at 11 years worth of data. And it's a day trading strategy, which means we're in and out within the session. Now the session on this particular market is like the London Stock Exchange, 8 AM GMT through to 16:30 GMT. So the rules are pretty simple. What we do is we look at this first bar during the day, and the guy suggested using 5 or 15-minute bars. Now this is something that we're going to test. I'm actually going to test it using 5-minute, 10-minute, 15-minute, 30-minute and 60-minute or hourly bars. I could test it even using custom bars. I could go in between like 20-minute bars, 25-minute bars, but I'm not going to, because that's probably not going to be appropriate for you if you're not using trading software. It's better off to keep to the more regular bars. So let's assume this is a 15-minute bar. We want to wait for this bar to finish. So at 8:15 in the morning, we're going to look at this bar and we're going to pay attention to the high and the low. Now, he suggested that you use stop orders 2 pips above and 2 pips below the high and low of the bar. So let's imagine that this bar's just closed, and a few seconds later, the open of the new bar's here. If the market was to go down, then we would already set in our stop orders, so to sell short 2 pips below the low of that first bar, and the opposite's true. Put a stop order 2 pips above the high of that bar in case the market rallied and then got us in on a buy. I've also got a stop loss, and predictably, it's quite simple, it's the other order. So if we got in short, our stop loss would be this order 2 pips above the high. Okay. Now, there are some other rules that I've included or the guy suggested. Now, it's the number of trades per day. We're only going to take a maximum of 2 trades per day. Because what can happen is, let's say that the market came down like this, and then perhaps it went up here, and it would have stopped us out of our short trade, so we would have had a loss, but it would have also got us into our long trade. But then later on in the day, let's say the market went back down again, and it would have stopped us out of that long trade and perhaps got us back into a short trade if we reset the orders. Certainly, if you're using an algorithm, it might do that. So I've actually programmed and limited the trades to 2 per day. However, there is an extra little twist there. If the first trade of the day, so let's say this one, we've got in short and it's hit our profit target, and I'll tell you what the profit target is in a minute. If it's hit our profit target, so we've had a winning trade, that's it. We stop for the day. We only take the 1 trade because we've made our money and we want to go and do something else, wait for tomorrow. If we get stopped out of the first trade and in the second trade, if our second trade is then the winning trade, has hit our profit target, great. Again, we stop trading, maximum 2 trades, wait for tomorrow. there's a chance that we get stopped out of both trades. Both trades are going to be losing. In that case, predictably, stop trading. Maximum of 2 trades a day. Yes, we've had 2 losses, but don't trade the market anymore. Wait for tomorrow. There's also a chance that we'll get in on the first or second trade and the market is very quiet. It doesn't really move much during the day. So it hasn't hit our stop loss and it hasn't hit our profit target. So at the end of the day, a few minutes before the closing time, we just want to get out of the trade. Whether it's a small loss or a small profit, just get out of the trade, because this is a day trading strategy. And out of the trade, wait for tomorrow. So profit target. Profit target is quite simply a limit order. So, and again, we're looking at these levels. Let's say this first bar, for argument's sake, was 15 pips. And our entry is 2 pips above or 2 pips below. So our risk or our stop loss would be the 15 pips plus 2 and plus 2. So it'd be 19 pips. So we're actually going to use that same 19 pips for the stop loss and the profit target as well. So that's quite simple. And that's something that we're going to test. I'm going to test, maybe we want a smaller target or maybe we want a bigger target. That's the beauty of using software, that it's very easy to test. One other rule that I should perhaps mention is a volatility filter. Now, the guy also suggested pulling up a daily chart and putting the average true range on the daily chart. He suggested a 5-period ATR. And only trading if the ATR was above 60. So there was a certain amount of volatility in the market, because we don't want to be trading quiet markets, because we can just sort of go up and down, get stopped out, or go nowhere. We want to make sure there's a reasonable amount of volatility in the market. And I've tested all different levels with the average true range volatility filter as well. So those results are quite interesting. And I think that's about it for the rules, really. Probably become a little bit clearer when we look at the computer. So why don't we go over there now? I'll show you each and every sort of optimization and stage of this, and then we'll come to a conclusion at the end. Okay then, right, we're at the screens. Let's have a look. Let's go through these different workspaces or different stages of this development and look at the different tests that I've done, see how it impacts results. The first screen we're going to look at is using the 15-minute bar. So at 8:15, we're going to have a look at the bar, putting our orders from there, and we're taking 2 trades per day, and our profit target is 1 times the risk. So the profit target is literally looking at the size of that bar plus 2 pips either end, so plus 4 pips. And at the moment we're taking 2 trades per day, and we're not using that ATR filter on the daily chart that I mentioned, not at the moment. So let's have a look at the performance report. We're looking at the equity curve, most importantly, and that's actually a really nice, surprisingly good looking equity curve, isn't it? That's all trades, because we're long and short. That's what the long trades, if we just took the long trades, and that's what the short trades look like. So it's actually pretty good. Look at the period analysis. We can see that apart from 2 years, 9 out of those 11 were making money. Okay, so not bad at all, and that's looking at the 15-minute bar. But I did a little optimization, like I said, using either the 5-minute bar or 10-minute bar, 15-minute bar, all the way through to the 60-minute bar. So let's have a look at the results from that optimization. Now, if we look over here at this column, my entry time, 8:05, that means that we're looking at the bar at 8:05, so it's a 5-minute bar. The next one down is 8:10. We start to look at that bar at 8:10, so we're using the 10-minute bar, and so on. 15-minute bar, 20-minute bar. you'll notice through the optimization, don't take any notice of these times, because 860 is clearly not a time. It's just the way that the software recognises it. So it goes from 8:55, and the next one's 9 o'clock. So the 9 o'clock would actually be using a 60-minute bar or an hourly bar. And what we're really interested in is looking at the average trade value and the net profit. So in fact, the best net profit was that 15-minute bar, and also had the best average trade. Took slightly less number of trades than if we'd used the 5-minute bar, but it's definitely a considerably, the average trade value is twice what it was on the 5-minute bar, and the net profit is well over double. The next one that sort of comes close is looking at the 30-minute bar, believe it or not. However, if we go on and the performance quickly diminishes, personally, I feel more comfortable using that 15-minute bar. We'll have a quick look at the 5-minute bar. So I've just selected that input now. So the results that you're going to see now are going to be using the 5-minute bar, and we can see we've had 3 losing years probably, so we've racked up a few more losses. We've made nowhere near the profit, remember, that we just saw. Look at the equity curve, and it's not quite as consistent. It starts to get really wobbly from sort of 2016 onwards. It pretty much went sideways. So I would safely say that I'd be more happy with that 15-minute bar for this one. So the next strategy, the next development I've done was I stuck with the 15-minute bar, but what I did was I optimized that 2 pips above or below the high or low of the bar. Remember, the gentleman that suggested this to me said you want to put in stop orders 2 pips above the high or 2 pips below the low. And I wondered whether that was best or not. So test it out. So let's have a look at the results. And you can see in the test, I've called the input my pip buffer. And I've gone from 0 to 15, so I've tested that. And looking at the results, the best in terms of net profit and average trade, fun enough, is 2 pips. Now, there's a few things that I've noticed here. The 15-minute bar thing and the 5-minute bar, they both worked. The two pip buffer, it's clearly the best. It makes me wonder that the rules where my subscriber got this strategy from makes me wonder whether it's already been pre-developed. So, some of these strategies you get that people just sort of make them up out of nothing, and they get lost in translation, and they're not always ideal. But a lot of the things on this strategy, they all seem to be just about right how they are, and my testing is adding up too. So that 2 pip buffer is about right as far as I'm concerned. So moving on to the next workspace, where I wanted to look at the profitability, or the profit target, should I say. So I mentioned that I've actually set it as a multiple. So if I set my profit target to be 1, what that means is, it means I'm looking at the size of the bar, let's say 15 pips, plus the 2 pips at either end, so 19 pips. So if my profit target is 1, or 1 times that, it's 19 pips. If it was 0.5, my profit target, then it would be 19 pips divided by 2. Okay, so I've tested that, and let's have a look at the results from that. And I went from 0.1 multiple, so if it was 19 pips, 0.1, we'd be looking at a 1.9 pip profit target, right the way through to 2.5 times, so 19 times 2.5. And the results, looking through the best one, fun enough, it was exactly on 1. It was that really amused me. It made the best net profit and it had the highest average trade. Now, those of you who are into strategy development, if you wanted to start tuning your strategy to suit you, you might say, obviously it's the biggest net profit and the biggest average trade, but we're looking at a 56% accuracy rate, so we're right 56% of the time here. If you wanted to make a strategy that you were right more than that, look, if we used a smaller target, look at how the percentage profitable goes up as the target is smaller. I just thought I'd add that in. I mean, that's how we can sort of tune strategies. So the next one we'll look at is how many trades per day. I mentioned that we're only taking a maximum of 2 trades per day, and they could both be losing trades. Let's just see if I can find some. Here, for example, this day here, we had a short trade, got stopped out long, and we then got stopped out. And if we allowed to trade on more, we would have got back in long as well, and we would have had a losing trade. Or we have 1 trade per day, and if it's a profitable trade, we stop trading. So the 2 tests that I'm going to do here are looking at taking the 2 trades like you see here, or the other test is just taking the second trade, so ignoring the first one. So we're kind of pretending that we're going to get the signal for the first trade but not actually take it, and then just take the second trade because I had a feeling that it could be a better quality trade than the first one. So let's look at the results from that. And trades per day is literally 1 and 2. Now, the way I've programmed it, 2 trades per day is the one that is taking 2 trades a day, the one we've looked at so far. 1 trade per day, that's literally just taking that second trade, not the first trade, but the second trade. And you can see, look, it takes way less trades, only 1,400 trades, as opposed to over 4,000 trades. Net profit's way lower because we're taking way less trades. However, the quality of the trade is ever so slightly better. We're looking average trade of 11 rather than 10. Let's have a look at the equity curve for just trading that, just out of interest. And it's quite a nice equity curve. So look at the annual analysis. A few more losing years, but it certainly works. Probably not something I'm going to consider trading. I actually prefer the results. Far more net profit from taking both trades. So it was something I wanted to check, nevertheless. And the last optimization I did was looking at that average true range filter. So it's an average true range of 5-period ATR on the daily chart, and the numbers you're going to see are we're only taking the trades that day if the ATR is above a certain level, and I've actually looked at it. Well, let's have a look. I've checked levels between 0 and 150. Okay, so anything above 0, that's all trades. These are the results. This top one here was the results that we've been looking at all along. And we can clearly see that in terms of net profit, 30 ever so slightly better, but generally taking all trades is about as good as it gets. Look at the average trade as well. Okay, 30 ever so slightly better as well. It's a difference between 3 trades. Look, 4,130 and 133. It's barely worth touching. What is worth noting is the average trade. Look how the average trade starts to go up and up and up consistently as the ATR threshold, as I call it. So here we've got to have an ATR of over 120, which is quite extreme for the FTSE. And the average trade value does go up, but the net profits come right down because there's a far lesser number of trades, like only 470 trades. Out of interest, let's just have a look at the equity curves of. Now, the guy did actually suggest using 60. Looking at these numbers, I can't see any benefit for using 60 particularly. We will have a look at the equity curve using 60 as well. So the equity curve now, this is looking at an ATR above 120. I mean, look, some years we didn't even trade. So some years the ATR never got above that. The curve, that's the equity curve. Nothing screams out that it's a very good strategy looking at that. Let's just check using that input of 60 out of interest. So I've selected 60 and we'll have a look at the test results. That's the equity curve. Nice equity curve. Yeah, look at the period analysis and no, just one losing year. So that's probably the best yet. Again, do you think somebody's already optimized that value? Perhaps. So 60 is an option. Probably not something I would bother with. Get the longs and the shorts. So there you have it. That's the results for this breakout strategy. Now, my job is to go away and to try and improve it even more. Something I haven't mentioned that I did test was I had an end time for this strategy where if we hadn't hit the stop loss or the profit, I'd get out at the end of the day. I actually tested that as well. I tested it from like 10 o'clock in the morning through till the end, and the end of the day kind of worked the best. I've actually used 16:20 as an exit time rather than leaving it till the last few seconds of the session. I found generally exiting at 16:20, the FTSE works quite well. So my job now, like I say, is to go and improve it even more, because unfortunately, I don't believe this strategy makes any money. Even with an equity curve as nice as that, I don't believe it makes any money because of the size of the average trade. Let's go back to it. Look at the size of the average trade. It's saying that our average trade is £10. Now, I haven't included any costs, any trading costs in this report. So there's going to be a cost for the spread and slippage and possibly commissions. So by the time you've taken those out, trading at 10 contracts, I know that we're going to be looking at costs of probably at least £20 per trade. So we know it's going to be £20 per trade minimum. So if we're looking at an average trade value of only £10 a trade, it's a losing strategy. So that's a real shame that that average trade value is that low. And it just goes to show that we can see some nice consistent behaviour. We can see that by the shape of the equity curve, but it's not that easy because you know, with an average trade that low, you're just not going to make any money. And that about concludes today's video. So I hope you like that. I hope you enjoy looking at the results from a basic mechanical strategy. Like I said, I've been doing a lot of work on the FTSE at the moment. If you've got any ideas that you want tested, occasionally I have strategies come up. I haven't come up quite a lot, but occasionally they really spark my interest and I want to test them myself and have a look. I actually provide that as a service as well, so a programming service. So if you're interested in that, go and have a look. There's a page there on my website. That's thetransparenttrader.com. If you want anything programmed, and we can make it automated as well. And I'm going to go away trying to improve this strategy even more. If you've liked the video, please give it a like, and if you haven't subscribed, please subscribe to the channel. And if you need any help or got questions with anything, you can email me, jared@thetransparenttrader.com. And until the next one, this is Jared Goodwin, and thank you.